Hello, everyone. Welcome to today's quarterfinal of the Young Actuaries World Cup. My name is Henning Bergen, and I'm very happy to welcome you to today's quarterfinal for the European Continental Zone. Very much looking forward to the event today. We have quite something on our agenda, so let's start right away. Where are we right now? Perhaps you know and have been following the Young Actuaries World Cup. We went through a qualification round for all in all 6 regions worldwide: Africa, Asia, Europe, Latin America, North America, Oceania. We went through the qualification round with 4 winners for each region. Today we are in Europe, going through the quarterfinals. We already had 2 of them, Africa and Asia. Today we are here. We are looking or in search of 1 winner that will automatically proceed to the semifinals, and a runner-up, which will then be kind of a lucky loser with a chance to also proceed. As I said, we are in the quarterfinals with the main goal to decide on the 4 finalists that will be able to go to the International Congress of Actuaries end of May, beginning of June in Sydney. What do we expect of today's quarterfinal? Well, not only today, but of all quarterfinals. We will have a short introduction of the judges. We will spend some time on the 4 quarterfinalists, view their videos, and then give the judges the opportunity to ask a question, with every participant having 2 minutes time to answer the questions. We will be quite cautious about the time to just give everyone the same chances, same opportunity. Afterwards, we will take, well, some of us will take a 10 minutes break to give the judges the time to decide on the 2 winners, place number 1 and place number 2, so that we then can proceed from the quarterfinals to the semifinals. That's the plan for today. Who are we within today's webinar? As I said, my name is Henning Bergen. I am a member of the Young Actuaries World Cup Task Force. Luckily, it's a great joy to be part of the group. I'm the Europe Continental Zone Ambassador and a member of Deutsche Aktuarvereinigung, DAV, the German Association of Actuaries, and in that role, part of the task force. With me today are our 3 judges: Mary Frances Miller from the Casualty Actuarial Society, Pedro Pacheco from the Colegio Nacional de Actuarios in Mexico, and Seth Ishun from the Actuarial Society of Ghana. We will see them later on when we come to the questions and answers to the participants. So let's start right away to the more or less most important part. We have 4 quarterfinalists that went through the qualification round. Catherine and Amir from the Institute and Faculty of Actuaries, you see them UK. 1 participant from France, Thomas Herbin, and 1 participant from the DAV, Jan Küte. You see them split through Europe. We had a very good group of candidates from Europe. Those 4 advanced, and very happy for them that they put so much effort. Not only the 4 of them, but many participants from Europe put a lot of effort and work into participating in the Young Actuaries World Cup. Here you see the 4 of them. We give every one of them enough time later on in their videos as part of the Young Actuaries World Cup, which made them qualify for the quarterfinals. With Catherine Townsend, 30 years old, from London, works with AXA UK. Namir, 25 years old, also from London, works with EY. Thomas Herbin, 27-year-old from Montreux, working with KPMG. And Jan Küte, 30 years old, from Cologne, working at Accurate. You see their topics, and we will have enough time in their videos to proceed. Starting off, first off, Katrin from Institute and Faculties of Actuaries, A Bridge to a Net Zero Future. And I'm happy to start the video. And I very much hope it works. If not, please give me a short indication if there's a problem.
Net zero is the future, but how do we get there? In this video, I'll propose 3 steps actuaries can take to bridge the gap. Insurance enables people and businesses to go about their lives without the risk of catastrophic financial loss. And that's great if you're enabling good, but less so if you're enabling major polluters. But despite over 29 insurers being part of the Net Zero Insurance Alliance, only 3 have made the commitment to cease writing oil and gas. And there are 2 big reasons for this snail's pace. Firstly, that sudden underwriting exclusions won't help customers make change, and it can even be destabilizing for them and the economy. Secondly, and rather more cynically, the oil and gas insurance market was valued at $18.5 billion in 2020. That's a lot of top line to lose, but we know that climate change makes natural catastrophes more severe and therefore more expensive. Insurance is a social good, but it needs to generally be profitable to be sustainable. We shouldn't continue to enable the worst polluters while paying through the nose to indemnify others from their effects, so we need to start bridging this gap now. The first thing actuaries can do is to extend their toolkit from risk quantification to risk allocation for catastrophe claims. One way this can be done without hitting the top line is to reduce claim payments in a risk-based way by reducing the amount of cover provided to polluters by an independent and objective measure based on how much they've contributed to the risk of this event occurring. For this, we can use the IPCC's method of risk allocation. For example, for the UK flooding in autumn 2000, they were 90% sure that anthropogenic greenhouse gas emissions increased the risk of this event by more than 20%, and 66% sure of an increase of more than 90%. With industry consensus, risk actuaries could use a given risk tolerance and reduce claims paid to large polluters by this amount. These risk attribution estimates now only take days to complete, so would likely be available for all major weather events around the time that early claims estimates are made. Or to take another example, in 2005, Hurricanes Katrina and Rita destroyed 109 oil platforms and 5 drilling rigs in the Gulf of Mexico, the most valuable of which was worth $330 million. Higher sea levels caused by carbon emissions led to the flood elevations being 15 to 60% higher than otherwise. Even if we take just the bottom of that range, on one rig alone, the claims payment could be reduced by $49.5 million. This would be a relatively easy thing to implement, but it would be a big step in getting polluters to bear the risk of their own actions. Step 2 on our bridge to net zero involves getting polluters to pay more for their insurance. Actuaries could implement this by using a pollution-based metric as an input to their pricing models. This could be carbon emissions of a company, but it could also be adapted for retail products too. For example, by using home efficiency rating or the amount of fuel usage. In fact, this methodology could be used for any pollutant, whether that's the amount of sewage dumped in water or even plastic production. The idea is to penalise the policyholders' polluting behaviour, with the aim of encouraging a behaviour that reduces risk overall. And by using publicly available independent metrics, this extra premium is effectively a levy that could and should be applied equally by all insurers. Step 3 is that this creates a massive pot of money. So what should we do with it all? Well, there's a few options. We could use it to subsidise insurance for those most affected by climate change. For example, by using this to fund schemes like Flood Re. Or we could subsidise insurance for those actively helping the transition, like renewable energy companies. We could use it to build back better, that is, to augment the claims payments to those affected by natural catastrophes if they reduce their future exposure to risk. This could be by adding additional flood prevention methods or even covering moving costs. Or we could use it to help the sustainability of insurers after a natural catastrophe. This would act like an industry catastrophe buffer. For NatCats over a certain size, money is taken out of the fund and used by insurers to pay customer claims. This would help protect insurers from the most severe events and ensure a stable and sustainable supply of cat insurance. So step 3 is really the fun stage because it's full of exciting possibilities and opportunities for actuaries, not only to create a fairer and more equitable society, but it also provides an amazing platform for actuaries to promote their skills and expertise in dealing with complex, converging global risks. So that's my 3-step plan, but will it work? Actually, history has shown that it will, because steps 1 and 2, reduce benefits and increase contributions, have been the 2 levers to making defined benefit schemes sustainable. In that context, the aim was to transfer risk from companies to individuals, and it worked. I propose that we use the same 2 levers over the next decade, but with the aim of transferring risk from those affected to those who are most driving climate change. These steps are naturally and steadily going to decrease demand for oil and gas insurance, while actively encouraging those who produce or use the most pollutants to change their behaviour. And that's how actuaries can create a bridge to a net zero future.
Catherine, thank you very much for the video, and very happy to now hand over to the judges for their 3 questions to you. Perhaps, if possible, Mary Frances, would you like to go first?
Sure. Katrine, what area of the insurance industry would you see as taking the first step in implementing your plan? And how would they go about it?
Thanks so much. I feel that the oil and gas industry is the obvious first step. So particularly for general insurers there. So the first thing I would do is, and you could literally do this today if you had the underwriters on board, is that you would just change terms and conditions to say that if there is a cat, you're going to reduce the sum insured by that independent and objective metric from the IPCC. And you could literally just add that contract term in already. Similar contract terms are already in things like household insurance. For example, if a policyholder has understated their sum insured, there's often a little line in there somewhere saying, if you have understated your sum insured, we're not going to pay the full value of your house, we're going to reduce it by the amount that you understated it effectively by. So there are similar the policy wordings in the industry around today. We just need to find them and put them into oil and gas cat insurance covers, and it'd be a really quick thing to do. We could literally all go back to the office this afternoon and do that if we had underwriters on board.
Thank you.
Pedro, would you like to go second?
I'm so sorry, Pedro. I think you're on mute.
Yes.
Yeah, sorry. First, congratulations, Catherine. Very interesting work you have presented. I was very carefully listening the 3 steps that you mentioned. The one is the one reducing the coverage or avoiding some risks. The second one is making more expensive the insurance coverage. And the third one is like establishing like a bonus for some kind of protection or metrics or techniques that the industries will be using to avoid these catastrophic events. My question goes specifically if you want to make like a subsidized insurance program in this step 3, which is the one that you mentioned is the most interesting for actuaries, which statistics do you think you may find to make your model and your work being consistent with what you think?
Thank you so much. So I think that we don't have long to work with here in terms of when we want to get to net zero by. If we want to hit that target by 2030, we need to make pretty speedy steps at this point. So I don't think I would be setting up all new products or all new structures. I think the easiest way to go about this is to fund programs or amend programs that are already there. So that could be something like Flood Re that we have in the UK, which means that policyholders who already live in flood-prone areas can access subsidized insurance. That's through a government scheme. And I know the US has a slightly flawed national flood insurance program. I also know that, for example, New Zealand, I believe, has a very good cat insurance model. So we could use one of those government schemes or create a similar government scheme that we could fund. But there are lots of other interesting things that we need to do with the money. And I'm sure we're going to talk about climate litigation risk, for example, but there are lots of communities now stepping forward, particularly Indigenous communities, saying we're most affected by climate change, but we don't currently have insurance. What are we going to do? Who's going to help us and protect us? So the money could equally go to people without insurance and could be used for those communities. And I think this redistribution of money from oil and gas companies who made a $200 billion profit last year, just moving some of that wealth to affected people, particularly in the global south and Indigenous communities. I think that's really important going forward. And as actuaries, we have a duty to the public. So I think that is an important step for us.
Thank you.
Thank you, Katrin. Third one, Seth, your question, please.
Thank you, Catherine. It was a good presentation and well done. I wanted to ask about, in terms of cost-benefit analysis, what are some of the costs that would accrue to one, policyholders, to two, insurance companies in trying to implement the things that you talked about in terms of reducing coverage, in terms of it being more expensive, and in terms of the new types of insurance product that will come into being? What sort of cost would come to these two different players?
Thank you. Yeah, so as I mentioned, I wouldn't be necessarily setting up schemes. I would be funding and better funding existing government schemes. So I don't see lots of extra costs there, although obviously that is an option if we wanted to use that money. However, I think the really great thing about my 3-step plan is that the first step is free. At least in the short term, to insurers, we just change our policy wording and reduce that cover down. So that is, minutes of underwriter time. It's not that upfront expense that I think a lot of things when we talk about getting to net zero, they do involve upfront expense. So this doesn't have that. In terms of a cost, there would be a cost to the oil and gas industry if there were a cat event that they were deemed, or the anthropogenic climate change to which they have hugely contributed, if that was found to be the main cause of that cat event, then yeah, that cost would be with them. But that's the same as most other policy holders and most insurance coverages. There's usually some kind of deductible, some kind of excess, some kind of limit. So I mean, that kind of risk would still be there for them. And quite frankly, like I said, last year they made historic profits. So I think there is a real justice consideration here. Should the people, are we happy as a society that the people who create the risks pass that on? Or do we want to create a scheme or a system of risk transfer where the people who create the risks, they do have to pay for those risks? And I think that's what this comes down to. I think this all comes down to justice.
Wonderful. Catherine, thank you very much for the presentation and for answering the 3 questions. Now it's time for you to lay back and listen to the others. And I'm very happy, thanks again, to proceed. Next one would be Namir, also representing the Institute and Faculties of Actuary, and he will be, as already announced, talk a bit about climate-related litigation risk, and I'm happy to share the video with you.
Hi there, my name is Namir. I'm from the UK, and I'm really excited to speak to you about this fascinating and fast emerging subtopic of the theme of climate risk. We've always conventionally split climate risk into 2 interrelated but distinct topics: physical and transition. We're already seeing movements in the transition risk space where asset owners and asset managers are increasingly embedding ESG expectations into their investment strategy, which is a really, really interesting move. And on the other hand, in the physical risk space, we weren't really expecting that to crystallize until much later in the century. And yet we're already facing natural disasters that are rocking entire nations this year, such as mass flooding in Southeast Asia and wildfires and heat waves spanning the globe. But the reason I'm making this video and speaking to you today is about a third equally interesting and yet under-talked about issue, and that is something called climate-related litigation risk, or CLR for short. Climate litigation risk refers to lawsuits and cases brought to judicial courts on the topic of climate change. And they can range from allegations of greenwashing to measuring data on scope 3 emissions to having too many emissions in the environment, which can violate a duty of care and violate basic human rights. These cases can span a huge number of topics in all different directions. And that's a really fascinating space because that's only going to grow when precedents get set. Now, there was already a fascinating landmark case where the Royal Dutch Shell were effectively compelled to reduce their emissions by 2030 and make sure that their transition plans were credible and not overly dependent on technology that just doesn't exist yet. That's huge and a real moment to illustrate how a company is being compelled and told by law to be better and to act responsibly towards the climate. And that's only going to set the ball in motion for other companies and other sectors to follow suit. It shows just how powerful this tool can be. And already we're seeing so many interesting cases, such as aviation companies being sued for misleading claims, to a farmer in Peru suing an oil and gas company to say that the impact that they have had as a business on the climate has had a knock-on implication on a glacier in Peru. You know, we are in a completely new world when it comes to being able to measure impact and being able to hold companies and people responsible for it. Now, what does that mean for the financial services sector? And that's a valid question because the majority of these cases are focused towards the oil and gas sector and utilities and ones that are really carbon intensive. But actually what we're seeing is that being extended into financial services. I'm co-authoring a paper right now on that topic with the Climate Risk Financial Forum and the PRA to discuss this actual indirect and even in some ways direct impact. So let's talk about insurers for the moment. It's affecting the asset and the liability side. From the asset side, their investment strategy is becoming increasingly scrutinized and increasingly open to lawsuits. For example, if they invest in a company who in turn faces a lawsuit which can affect their stock price or their market value, or even, if significant and severe enough, could even cause a credit rating transition, that would have huge ramifications on the investor, whether it's through corporate bonds, whether it's through equity investments, which are a little bit rarer for most insurers. We're facing and seeing some real knock-on impacts on the asset side. But more interestingly, if you are seen to invest in a company that is actively contributing to climate change or being sued in turn, the insurer and the investor itself can be seen as financing climate change and financing those activities, which in turn can be sued through climate litigation. And we're already seeing precedent for that. That's really interesting. We've always seen positive actions towards investments as a good thing, but now we're starting to see a movement towards penalties for inaction or poor action. Meanwhile, on the liability side, it's a lot more unique for insurers, but equally, if not more interesting. Insurers' D&O cover and PI cover, and just cover for firms more generally, means that they might incur some huge settlements and claims going forward as climate litigation crystallizes and causes more payouts and more precedents being set in the coming years. We've already seen an example of oil and gas companies suing an insurer in America on the grounds that their legal costs weren't being covered for them trying to defend a climate lawsuit. So we're already seeing insurers and financial sectors being dragged into this space. This topic is developing right before our eyes, and the impacts could be huge. If we think about the asbestos impact on the insurance world just 20 years ago and think about what the impact of that was, this is much more wide-ranging and much more impactful, and yet we're just not ready for it. Insurers aren't talking about it enough or aren't conscious about this risk enough to be responding accordingly, and that's a really, really scary thing to come to terms to, which is why I'm actively trying to bring this topic to attention and make sure that it's being dealt with accordingly. Now, it's not all doom and gloom. There are definitely actions that insurers and financial institutions can take, such as going through the policies that are most exposed, such as D&O lines, and quantifying that impact, measuring what the potential exposure could be under a variety of scenarios and stress tests, where the scenarios refer to different legal precedents being set across the world. So what happens if this case goes through on its merits? What happens if that case goes through? And making sure that insurers are aware of that. In addition, making sure that they're engaging with the counterparties that they are significantly exposed to. So any oil and gas company that they provide cover to, there is that two-way engagement to make sure that there are credible transition plans in place. There are actions in place to protect them from these lawsuits and effectively be more responsible and more engaged with the move towards transition and a sustainable world. This risk is real and happening before our eyes, and it's only a matter of time before it crystallizes to the point where actual losses are being discovered. And so it's so important that insurers are ready. Thank you.
So Namir,
Hi there.
not again.
My name is
One's plenty.
Yeah. Well, thank you very much for the video, and I'm happy to hand over to the judges. Pedro, perhaps to start now with you for the questions.
Yes, thank you. Hi, Namir. Congratulations, very interesting way in which you present the risk that is related to this litigation process that is arising. My question goes specifically because you made a very important comment regarding the asset risks. So I would like to understand more what is your perception, and also if you have an example of something that has happened within the assets risk regarding this.
Yeah, it's a really, really good question. And most of the attention in this area is on the liability space, but actually the assets has gone kind of under the radar. It's important because the asset side is very volatile, and any investment that a financial services firm has will be liable to some kind of attention. So, for example, if an individual company is coming under a lot of scrutiny and a lawsuit, and that tanks their stock price, that could have knock-on impacts on the valuation of the asset that the investor has. In terms of examples, I think there's two that really jump to mind. One is a big pension fund called Rest in Australia. I think it's like the second biggest pension fund in the country. And they were sued because they didn't have clear enough expectations with their asset managers to show that ESG expectations were in place. They weren't proving that enough. They weren't holding the asset managers to account to have that. And that lawsuit was successful, and they had to completely revise their investment strategy and the expectations they would have of their asset manager to make that happen. So that's really, really big, that you can't just, it's not just nice to have, it's actually expected. The other one that comes to mind is, I think it was ExxonMobil They tried to present themselves as a really green oil and gas company, which kept their stock price really high. And then scrutiny and documentation and research came into it and showed that actually that wasn't the case. And they are quite a problematic firm. And their stock price just absolutely tumbled within the space of a few days. And the fiduciary board and the board of directors and so on, they're being sued for being deliberately misleading and having greenwashing claims, which led to the investors losing the value in their assets. So it clearly shows that this risk is kind of attacking on both sides. And it might be an indirect impact, but it's a really significant impact for the exposure and the investments that any firm and any particularly financial services firms will have.
Thank you.
No problem.
Perfect. Wonderful on time. I'm happy to hand over to Seth for your question, please.
Thank you. That was an interesting presentation. Well done. I have a few questions. No, a few. I'll just ask one. It's an interesting point. Let's say there's a flood in Pakistan, but the cause of it could be something that happened in Africa or something that happened in Europe. So, climate-related risk, you could have some real people coming to sue people because they think that what they did contributed to the losses that they've done. But it could be also spurious people coming in. So you would need a lot of skilled people from legal, from actuarial, from a lot of things. What do you think are some of the concrete things, and what sort of bodies should be working in order to not let this just be an insurance issue, because it's cross jurisdiction, it's cross skills, it's cross professions. So what are some of your concrete steps that this doesn't just become an insurance or actuarial thing, but it encompasses jurisdiction and it encompasses professions?
Yeah, again, another really, really good question. It absolutely is holistic, universal, and oil and gas sector is at the forefront. They're the ones who are most exposed, and they are receiving, they're kind of being held to account by most of the lawsuits. So I'd say it's actually the energy sector and the utility sector that's at the front. It's just that the insurance sector and the financial sector are kind of a knock-on implication. And I think the point to raise is that you can't just assume that the most exposed firms are going to be companies and are going to be oil and gas companies. There are actually so many other knock-on effects. So I think you're right to say that it needs to be a cross-jurisdictional team. You're going to have legal aspects from the regulator, for example. The regulator really needs to monitor exactly how they're going to tackle this. Are they going to set expectations on what can be invested in? Are they going to set support for insurance companies to provide insurance? Because if you suddenly withdraw that insurance product, that's a problem. But yeah, you're absolutely right to say insurance firms aren't the only ones. There's a new case around a massive supermarket that's being sued because of their supply chain and human rights violations in their supply chain in particular. So every single sector is being tackled at the same time. And these cases will only proliferate as governments, and not necessarily governments, but different legal courts around the world set those precedents. And I guess what's interesting about the financial services firm is they tie that all together. Ultimately, they'll finance a business expansion, or they'll provide opportunities to kind of allocate asset investments. So there isn't really something that everyone can do, but each firm needs to understand what their exposure is, whether it's on their policies, whether it's slavery in their supply chains, whether it's regulators providing enough support and capital. That's the kind of interesting question.
Perfect. Thank you very much. Mary Frances?
Sure. So you cite at one point asbestos as a precedent for the insurance industry to worry about. And I guess I would push back to some extent and say that the environmental and asbestos crises have changed the way insurers approach indemnity cover. And the insurance companies, in fact, have mitigated their risk to a very great extent And you do point out that there are certainly exposures still there for insurers. But what can insurers do on the positive side? How can they make a positive impact rather than just protecting themselves in this environment?
Yeah, it's a really good question. You're right to say that asbestos is a different scope, and we've moved on significantly since then. But I think some of the actions that were taken to mitigate asbestos exposure don't necessarily apply in the same way. And I'll give you an example. Lloyd's of London released this new policy exclusion to say we won't cover climate-related losses, but that's come under a lot of regulatory scrutiny to say you can't just say we won't provide cover for a whole wide-ranging set of elements. You have to be more specific. And even though asbestos is a very specific issue, climate change more broadly is way more all-encompassing. So there are some real questions that insurers kind of have to ask themselves. On the positive side, it's a great point, and some insurers are already doing that. They're deliberately providing cover as like microfinancing for small businesses and small entrepreneurs in the most climate vulnerable countries. And so providing that insurance cover along with banks providing microfinancing is a really nice dual approach to enable innovators and entrepreneurs to do that. And I think that's really, really powerful. So insurers can really take that positive step. There was something that Catherine mentioned earlier around flood re, which is again a really, really powerful positive scheme that was taken to ensure that people who need insurance, who can't have a home without that protection, it is enabled. And I think also insurers providing some kind of like counterparty engagement is really, really powerful. So if they actually connect and reach out to the biggest pollutants, to firms that are going to be most exposed, to banks that are already financing oil and gas expansion, if they proactively show their kind of evidence of engagement and activities to those counterparties, that's really powerful. And it shows that they're thinking ahead, they're also protecting themselves, but also seeing how the world is going to move and the unique role that insurers can play to kind of enable that green transition, which I think is a really positive move.
Thank you.
Thank you.
Wonderful. Thank you very much, Namir. Which brings us to our next contestant, Thomas Abel from the Institut des Actuaires. He will talk about car insurance, a bridge to carbon footprint reduction. And again, I'm very happy to share his video.
Hello, I'm Thomas, and I'm here to talk about my project. Not that I want to spoil the mood, but I have to start with an inconvenient truth. Our planet is facing a major crisis, which I'm sure you've heard about. I'm talking here about the environmental emergency. As an actuary, I was looking to make a bridge between insurance business and reduction of carbon footprint. Thanks to research, we are able to know what are the major sources of pollution and what is the estimated carbon footprint of each sector. In France, the sector emitting the more carbon dioxide is in transport, with the most of it coming from the usage of personal car. Furthermore, 40% of the daily drives in the cities are less than 3 kilometers long. Rides that could easily be done walking or riding a bike. Now, given that car insurance is mandatory in France, how could we help people to reduce their carbon footprint? The core idea of my project is to nudge people to reduce the usage of their car and reward their efforts by offering them financial reduction. This will be implemented through a digital add-on on existing car insurance policies. How does it work? I envision this add-on product as an app downloaded by the user on their cell phone. The app is functioning through 3 steps. Step 1. Enrollment and set of the goal. Through 4 basic questions, we will be able to draw the user profile and set his personalized objective. Where do you live? Where do you walk? How many of car rides do you do per week? And how many of those car rides are walk related? Based on the answer, the model will estimate the average kilometer traveled during a month. From this average, we will set a personal objective as a monthly maximum distance the user should try not to exceed. For example, Paola is currently driving 400 kilometers per month by car. Her target will set to a monthly distance of 350 kilometers. Now, what about step 2? Once the target is set,
Paula will take her car as usual and hopefully try to use her legs or bike to travel short distances.
we will observe Paula's usage of her car by simple picture of her car dashboard, which will give us the data of how many kilometers has been driven since last picture. Now, the best part, step 3, the reward. At the end of the month, thanks to the data of how many kilometers the car has been used for, the model will observe either the objective has been achieved or not. If the objective has been achieved, Paula is rewarded
With a bonus of a certain amount calculated by the model. At any moment, Paula will be able to effectively earn her bonus via either getting the gains through a cashback transfer, having her next insurance premiums reduced by the bonus amount, choose to buy a bike for which the insurer will subsidize the accumulated gains, or accumulate the gains to use it later.
If the objective has not been achieved, this is fine. Paula will try again next month. Now, what are the benefits for insurer to use our add-on on their products? First of all, an insurer using our add-on on his product will be granted by marketing interest, having a green and innovative image, distinguish its offer from competitors, and convince new clients to underwrite their insurance contract. Retain current policyholders by offering them premium reduction. At last, the decrease of car use will reduce the claim rate of the users and increase the insurer technical profits. For policyholders, our product will offer cashback by using a very simple and fun app and enable them to take part into the fight against climate change. So, are you ready to reduce your carbon footprint and being rewarded for it?
Thomas, thank you very much for the video. Happy to hand over to the judges for their questions to change. Perhaps let's start with you, Seth, for the first question.
Thank you, Thomas. That was an interesting one. I was comparing it to sort of life insurance or health insurance policies in which people are encouraged to exercise. They give them an Apple Watch or something that measures their steps, and as they become more healthy, they are. So that was how I was thinking about it whilst I was listening to your presentation. You know, with everything, changing behavior is the most difficult thing. It's always easier when you say the fault is the fault of an oil company, or is a fault of somebody who is logging. But when it comes to change, do you think that the incentives that are there are enough to cause the change that will cause people to change their behavior? And secondly, did you look at similar insurance policies that had these kind of benefits, like they give them an Apple Watch, if they exercise more, their premiums come down? How good those incentives has be, and whether it will help this sort of innovation that you are talking of?
Thank you very much for your interesting questions. Yes, I quite think that the incentive may convince people to change their behavior because it will be a reward with financial interest offered to the policyholders, to the car users. And I think it's a good way to make them think about the car use. In the same time, I think that if we are able to develop an user interface which is easy to use for the policyholders, with a kind of gamification of the add-on, we will motivate them to achieve their goal. Like it's a game. So I think it's a very good way not to be because we always see the car user as the people which made the pollution in the cities. But I think with the game we can make them change their behavior more easily. We can see some kind of there in this kind of insurance. I think it's always a good initiative, for example, like you said, in the health insurance, because I think the first step in this kind of problematics is to make people ask the question about their personal behavior. And that's for me the same for car user or for health insurance. And for example, with sports or the way the people may take care of their own health.
Perfect. Thank you very much. Next up, Mary Frances, please.
Yes, hello, Thomas. I'm really impressed with your proposal because I think it's implementable on a fairly wide scale fairly quickly. But I'm a little concerned that it might only be effective for urban consumers. Have you thought about whether it could be extended to people who do not live in the major cities?
That's a very good question. Thank you. Yes, it's one of my main concerns to make a product that can be used by different kind of user, low car user that we have in the cities, but even a larger car user around the cities or in small small town. And for this, I think, of course, in the first time, the add-on will be less efficient if there is no actual current mean to substitute the car use, of course, like public transportation or bike facilities. But I think we may adapt our products in two ways. The first one is to adapt the reward to the people who are not in the cities. For example, by to be more on the access of new way of transportation. For example, to rent for them a bike instead of giving them cash rewards. And in the same time, if we have enough users, we can develop some partnership with the application to solutions like carpooling in those kind of areas where it's not possible to do other than car, but at least we can encourage and nudge people to be not alone on their own car.
Thank you.
Thank you. And last but not least, Pedro, your question, please.
Yeah, thank you. Hi, Thomas. I congratulate you because your presentation is very practical. It's an interesting approach for something that could be easily implemented. I have some questions. I was impressed by the fact that you have a statistic that you say that 40% of the rides are less than 3 kilometers. That's a very interesting fact. Just to an example, here in Mexico, I have to ride 25 kilometers just to go from home to office. So I'm not in your statistic. My question goes specifically to the model, because you said that there is a model that has the way in which to calculate the impact. And obviously my question goes, how is this going to be analyzed, and how do you think this will affect the frequency of the claims?
Thank you very much. Yeah, of course, the model is a very central question on this product, because it will affect the current technical balance of the product by the fact that the insurer will have to offer rewards, so reduce his premium in a way. And in the second time, if the user reduces his car use, he will be able to, I hope, reduce the claim of the portfolio. So we'll have to maybe compare for example, the claim rates of user which use the add-on and the part of the portfolio that do not use the add-on to have a statistic about the effect of the add-on of on the user claims. And I think this argument of the claim rate reduction is very important to convince insurers, because there is on the one hand the fact that they will reduce the pollution and the claims. And for that, we need to have a first set of beta tester on our product in the first times, maybe to be able to calibrate that reduction of claim and to replicate this statistic on a larger portfolio and convince insurers to accept and make our add-on available on their product.
Okay, thank you.
Thanks to you.
Thank you very much, Thomas. So last but not least, our fourth contestant, Jan Küte from Germany, on the topic, who can save the world if not actuaries? And again, enjoy his video.
Hi, I'm Jan, a pricing actuary from Germany. When you start working, there are lots of actuarial activities where you think about math, statistics, and other theoretical matters. However, then sometimes you might feel a little disconnected from the real world. Each of those entries in a loss triangle show you a loss, respectively some destruction that happened somewhere in the world. And each of those individual claims you use for pricing stand for someone whose life might have been turned upside down. Even more than that, also questions of social justice impact our work. When you read articles about different life expectancy levels by income level of an individual, while only few products account for that fact, your next actuarial decision might improve equality. Or on a worldwide scale, when you observe that different exposure countries, and sadly especially countries with a higher poverty rate, have to the increasing number of natural catastrophes, you might want to think about mathematical tools to even things out. All this shows that we as actuaries work in the middle of important topics for the biggest part of all humans. And we need to fill that power with great responsibility.
So yeah, thank you very much. And I'm happy to hand over to Mary Frances for your first question.
Yes, sure. Hi, Jan. Can you give us an example of how you have applied the concepts in your video in your work?
Yes, happily. The most important example I would like to give are then about social justice and other social differences that are particularly important when you use features like credit risk or the very exact geolocation where a client is living for pricing, for using this information. Where it's a little bit of problem of a micro and a macro scale, that there is some significance, but still you are not looking at the very individual itself. And in those statistical tools, some truths, some properties of the insured individual are pooled, are meshed up, and therefore can of course also be combined with social injustices that you would want to remove from the factors. And thus you need to account very carefully when dealing in products where this could be a factor.
Thank you.
Thank you. Second, perhaps Pedro, with your question.
Yes, hi, and it's interesting your work trying to transfer data and formulas into real problems and with names and faces. No, so it's interesting. So my question goes: in your perspective, do you think the actuarial science needs to be promoted in a different way in order to see us that we face real problems and we work not only doing numbers that really do not represent anything? Is that your perspective?
I think to some extent, yes. It might generally be true for more technical jobs that this would be an important thing to do, as in the past, it was quite possible to become a specialist in one very exact field. But with the future evolving ever more quickly, everyone needs to be some type of an generalist, and us actuaries, of course, as well. And if you want to be a generalist, and if you want to be able to talk with others, you need to be able to address those problems and the solution you have developed with your tools. So so yes, I fully agree there that that's some shift in language, in culture, and thus of course also into opening up the actuarial profession to in even more diverse fields of future actuaries would be really valuable for us as a community, but also for those that we serve with our techniques and ideas.
Thank you.
Thank you. Last but not least, our final question for today. Seth, please.
Thank you, Jan. Thank you for the presentation. It was good. I wanted to understand some of the things. One of the issues that I thought about when you were presenting was some of the bias that exist in algorithms and in AIs. How do you think these principles can be used in that field, like the inherent biases that may exist in those algorithms and stuff like that?
Pardon me, could you repeat the last half sentence?
So you talked about justice and the likes, and I was asking that in a lot of things now, there's artificial intelligence, there's algorithms that determines this, but all those algorithms comes with inherent biases. So how do you think that your concept that you're dealing with, how do you handle inherent biases that may exist or may not exist in it?
Yes, thanks for this. Indeed very interesting part where sadly I won't be able to give a complete answer, as and that's why of course also the actuarial field is interesting. It's still under very much research what tools can be applied here and what not. So let me maybe first start with a somewhat general answer that comes to the very choice of algorithm, that you should only use tools that you understand as the most important one. This can then be for example, an algorithm where you can assign the effect quite clearly with neural networks and the cause of dimensionality, with the typical question whether it's a causational effect or just a correlational effect. You will get into many of those problems, that if there is any effect, maybe let's say connected to the gender of two insured people, that there will be a lot of other features that through some social reasons are also correlated to the gender. Maybe the tendency to buy a bigger car is connected to the gender, and thus bigger cars might get some of the effect in a model that would be assigned to the gender otherwise. So choose an algorithm that allows you to quantify where these tendencies go. And let me then maybe add as well the most important thing, I'd say, to not run blindfolded, to not just delete sensible signals from the information, to keep something like race in the data so that you are able to analyze and make and use it in your models, and not just say, I haven't used it, it's not, it must be fair. Don't do this, please.
Thank you.
Yes, thank you very much. This brings us to the next part of today's event. The judges and we all have seen the 4 videos. All the contestants had their chances to answer the questions, and now we give our 3 judges 10 minutes time to discuss and deliberate privately on their view, on their evaluation of the 4 presentations. So I wish all of you good luck on your decision making, perhaps combined with the hope that you find together and find a common view. I understand, and I'm happy that I can stay with the 4 contestants rather than having the discussion with you, because I would assume it's rather complicated to select number 1 and number 2 from the 4 very good presentations. So wish you good luck, and we stay together with the participants, having now 10 minutes time, and all 4 of you kind of talked about change and the need for change, and I understand that, and I think that goes hand in hand with the whole concept of the Young Actuaries World Cup, that you are perhaps not blessed would be too much to say, but none of you has like 10, 15, 20 years of experience in your professional career, but I understand that you have seen a bit and all have a couple of years professional experience. And I perhaps would like to ask all 4 of you how you currently see it in the actual environment, in the companies you work with or the clients you perhaps consult and work with. How's the mindset around change? Perhaps for actuaries, but in general within the environment. And perhaps I'd like to start in the same order. Catherine, how's your take on this?
Well, I actually do have 10 years of experience, Henning, so I'm just on that side of the line. My take is that we are in an unprecedented time. We all know that there's all these crises going on, but we are at a time when global risks are complex and they're actually converging as well. So there's these complicated converging global risks, pandemics affecting supply chain and climate change affecting biodiversity loss, which also affects supply chains, which affects health, which affects the cost of living, inflation. You know, these are not just, it's not just one isolated issue anymore. They're these converging challenges. And I feel very strongly that the way to deal with them is for actuaries to look up, to take your head a little bit out of the spreadsheet and to really see what systemic change we can make. And as Jan said, part of that, I think, is using the tools, all these fantastic new tools that we have, machine learning, AI, algorithms, etc., using those tools, but in a way that is inclusive, promotes justice, and really puts actuaries as people. You know, we want to be people at the heart of our very technical profession, because we do use numbers, but really we're all here for the best interests of the public, and that's who our duty is to.
Wonderful. Namir, would you like to add?
Yeah, I think that's a great answer. I think that's a really good summary of where we are today. I think it's tricky because there isn't a lot of historical data to work from. A lot of these crises that Catherine mentions, we've never seen them before, and it's really scary to be the first person through the door, to be the one who's going to try something new or set a new rule for themselves or try a new strategy in case it really backfires. So I think everyone and insurance firms are very much part of that list. They're all waiting to see who moves first and follow them, which is, I mean, it's a classic business strategy, right? It's always the second mover that tends to do the best whenever something new happens. But I think people are a little scared about how to tackle this. But I also think there is so much happening. It's really hard to drill down to the details. So using the kind of example of climate change, for example, there are so many models saying that the entirety of humanity will just collapse in maybe the end of the century, maybe earlier. And that's really hard to fathom. Like, what does that mean? What does that look like? It's such a visceral, but actually abstract picture. It's really hard to see what the impact of that would be and then work out what the steps should be taken to stop that. So I do really sympathize with people who, or firms who are a little sluggish, even though it's not good enough anymore and it won't really suffice anymore. I do sympathize in the sense that a lot needs to happen in a short period of time. But yeah, we'll see what actuaries and insurers do over the next 5, 10, 15 years, because it's really crunch time now. But yeah, I guess that's kind of my 2 cents on it.
Perfect. Thank you. Tomas, would you like to add as well?
Yes, I think it's a very tricky situation because I think that every insurers start to have the conscience about the emergency of the problem, but in the same time, there is no easy solution right now, and we can see, for example, about the transition, which is really hard right now to know how to adapt the investment strategy to face the transition risk, and what are the good way to be more virtuous on your investment side. Is it to not invest at all on oil, for example, or to invest and be more active in the board of this company? So there is no clear way to do this, but I think we have in our individual level we have to push for these changes, because the insurers won't do them alone. And the best example is the big steps are, I think, always realized when the regulator, for example, EIOPA in Europe, starts to ask for stress tests, for example, start to develop a taxonomy. And I think we have to push this kind of initiative, but at our own level.
Perfect. Thank you. Last but not least, Jan.
Yeah, thank you, Henning. I'd maybe like to focus on a small difference for this type of climate change we have discussed for the most of today, where most of the answers that will need to be given to fight climate change will need to be given on a global scale. And this comes with two problems: that it's way more difficult to enable this change on a global scale when sometimes your own company might be quite slow to move already. And also, you can't give that many different answers on a global scale. So the risk of giving the wrong answer is increased in this specific setting too, which is why it is that important to have communities like the actuarial community that has quite a lot of international exchange to discuss with lots of different contexts about those global change ideas and answers that we want to give.
Thank you very much. Perhaps one other point, I would like to have a short statement from you. We found out that all of you have been in the industry for quite some time, but are not that long out of your actuarial education, your actuarial qualification. And we already learned that we are in a time of change. Is there perhaps one insight, one hint that you would like to give yourself a couple of years ago, or future actuaries that will enter the industry or the industries in the future to come? Is there something that you would send to your future yourselves? Catherine, please.
I feel like I have an unfair advantage here because I did actually write a book last year specifically for this. It was a book of all the things I wish I'd have known when I was at university or a student or, you know, a youngish actor, you know, just starting out. I think the one thing that you should read the book. But I think the one thing for me is that there are so many different fields within actuarial science. So I started at Lloyd's of London and I hated it. And then I went into reserving and I hated it. So I, you know, now I'm in pricing. So I think for me, it's that actuarial science is not this weird cult. There's lots of little different parts of it. So go and explore before you settle down and find what you actually really love.
That's good to hear. Thanks. And so sorry for the advertisement on the book. That was not on purpose. Namir, please.
I'm sold. I'm gonna try and find it on Amazon and try and get this. Sounds like a good read. I don't know if this is sacrilegious, but I'm still doing my exams. I'm 3 years into being an actuary, so hopefully we'll be done this year. But I think it is a good question about the advice. I think I'll kind of maybe spin off a little bit on Katja's answer and say actuaries are really good, it doesn't sound like it, but they're actually really good at adapting with how things are changing. So when machine learning and when AI became really, really fascinating and really sexy 10, maybe a few more years ago, there was already an actuarial field and there were already sessions being led on the impact of AI and the impact of machine learning on model production and so on. With climate change, you already had a group of sustainable finance actuaries that were developing, you know, when all of this was still early talk. So I think actuaries are really, really good at staying on the pulse of how society is going, you know, on the zeitgeist. But so really don't think of actuaries as like really outdated or really, really old school mathematicians. There's definitely an element of that, and that's really important. But they are actually really, really good at adapting, which makes it a really good field to be in, because when you join, you actually have a really valuable skill set, which means you can join any other field if you want to later. So I think that's a really, really useful skill. And the last thing I'll say is know exactly what an actuary is before you start, because people will ask, what on earth, what's your job? Are you an actor? What does this mean? So have a one-line summary of exactly what an actuary is so that you can tell your family and your friends when they ask. But yeah, that's my advice.
That's the last one I would support 100%.
Yeah.
I think everyone something we have experienced all. So I see the judges are back. Nevertheless, Thomas, Jan, I would give you the opportunity perhaps for each one short statement.
Okay, a quick one maybe will be to try to associate your actuarial work and one of passion of things that interest you in your personal life, and for example, environmental problematics.
Thank you, Thomas. That's a very good point. Let me maybe add that I would recommend to keep your studies be it of actuarial sciences or even of mathematics or similar field as open as possible for as long as possible to really get the most insights from all those very interesting fields there. And whoever knows when you will need some functional analysis again for the next actuarial problem.
True as well. So thank you very much to the 4 of you. I had the feeling those 10 minutes passed rather fast. So thank you very much for this. Then I'm happy to hand over to Mary Frances, as far as I'm informed, to tell us who will join Dorota and Mika for the semifinals and who will be the runner-up.
So I'd just like to start by saying that all the presentations were really impressive, and this was a very difficult decision to make. So, you know, unfortunately, 2 of you won't have an opportunity to move on, and that's too bad because we would love to take all of you. So I'll start in second place is Katrine. And our first place for Europe is Thomas. Congratulations to all of you, and thank you so much for participating.
Wonderful. Thank you very much to our 4 contestants. Congratulations to the 2 of you. Thank you very much for the judges that have supported the work and all the work that has gone into it. Wildcard winners will be announced on 31st of January. Semifinals will be played between 16th and 22nd of February. And you see semifinalists have until February 9th to submit a new video taking into consideration the feedback provided by the judges. I'm also happy to invite you to our next quarterfinal, which will take place on January 18th. We have here the QR code to register if you want to. And this, more or less, with good luck. And again, thank you very much to everyone involved, not only in today's quarterfinals, but in the whole Young Actuaries World Cup. Very much hope to see as many as possible again in Sydney. Have a great day. Enjoy the rest of the Young Actuaries World Cup and see you soon. Thank you very much.